My name is Michael Frazis, portfolio manager of Frazis Capital Partners. Most of you know me, so I'll whiz through the background and what we do, and then I'll cover how the strategy's changed, because it has changed a bit over the last few years. And I'll go through some recent results in semiconductors and healthcare, which is also what we're looking at quite closely. So we invest globally in healthcare and technology, focusing on the fastest growing and most loved customer companies that we can find. And actually, I think over the last few years, there's even more examples of how effective that framework really is. And what we're trying to do is find the highest returning stocks in the market. And I think even over the last year, we got 3 of the top 5. We had one of the top 2 performers in Australia and the top performing stock in the S&P 500, which if you think about it, in a portfolio of 20 stocks is not actually that easy to do, but we really use this framework to do it. Since 21, the recovery has actually been pretty mixed. So your small caps have kind of gone nowhere. Biotech didn't get a full recovery. The red hot sectors like software didn't recover at all. Things like medical devices, with the exception of large caps, didn't. But there was a broad recovery last year in the Mag 7. And as this year's gone out, that Mag 7 has just been narrowed. That leadership has narrowed dramatically to the point where it's basically just Nvidia now in that group that has performed exceptionally well. We've had some good wins with companies in healthcare, with companies like Transmedics, Clarity. Obviously, we had Nvidia. And funnily enough, in South America, we had 2 really good performers, Nubank and Mercado Libre. So it was definitely a global approach, which helped us. We only have less than 25 positions typically, so we can really be focused on the handful of things that are performing well. So this is the line. So why customer love? The reason is it's actually pretty rare. There's only a handful of companies that have this. I used to give the examples, companies like Apple and Tesla. There's a new one, which would be Nvidia. You could argue that was there the whole time. In the last couple of years, anybody you speak to in the industry in Nvidia will list the reasons why it's vastly superior than the alternatives. And the growth that it had, the explosive growth that it had, was way in excess of any of its peers, and its returns followed. And really, that's kind of where we start. Which are the companies that are selling twice as much product today as they were last year? If they are, there's something really interesting going on. Often some of these ideas come from the products that you're using. And I'd say that in general, that's been a pretty good guide. There's that famous thing, if you bought an iPhone, if you bought Apple stock instead of the iPhone, how much the fortune you would have made. That also is true for Tesla. It's also true for Netflix. If you put your monthly subscription to Netflix, you'd have a small fortune now. It's funny, often that customer love thing really does lead you to the best performing stocks. This is a cue for the iPhone from the Daily Telegraph in the UK, which funnily enough, actually, the article was about why only men queuing up for iPhones, which you can definitely see in that photo. But it really shows there were a ton of smartphone companies. There was Nokia and BlackBerry, Microsoft, and then all the new ones that came in like HTC, Sony, and Lenovo. And in terms of why this works, this shows the operating margin. This is Apple, Nokia, Samsung, Sony, and LG. You can see the iPhone was released 2009 and rolled out 10, 11, 12. Apple's operating margin went from mid-single digits, basically just one of the other many competitors in its space, to 30% plus, whereas many of the others operated on razor-thin margins. This is operating margin as well. This isn't after-tax profits or distributable cash flow. So the real numbers are much more significant. And there are many years where Apple basically captured the entire profits of the whole industry. And that led to pretty phenomenal performance relative to the rest of its peers. So if you index this to say 2009, this chart would be much more significant. But even so, even if you index even further back, this period of outperformance was pretty spectacular. There's another example in the auto industry. I used to have Tesla here, but Tesla's kind of run into problems. Growth is stalled. It doesn't really tick those explosive growth criteria anymore. But you can see here, Ferrari, which is the ticker race, has significantly higher operating margin than all of its peers, which is scratching around on low single digits, maybe max 10%, which you can see where BMW is, which is a premium brand, but doesn't capture the imagination as Ferrari. It doesn't have a waiting list. It's not able to charge the same way. And if you go forward, that actually led to, not surprisingly, Ferrari being one of the top performers. And so again, this stuff is really profound, because being able to pick the top performing stocks in smartphone industry or the auto industry, there's hundreds of billions or even trillions of dollars hinging on these questions. Certainly now with big tech doing what it's doing, these are multi-trillion-dollar questions. And that leads us to our new example, which is Nvidia. And so this is just a chart which tells a bit of a story. You can see the operating margin has gone up. It's up to 60%, but it wasn't always like this. It was much choppier. And also you can see in the orange, the year-on-year growth of revenues. And it's kind of interesting that when revenue growth was negative and operating margins dipped, they were the best times to buy. But the problem is you can't actually use that. That's not actually an effective way to pick stocks because companies declining energies and bottom of cycle operating margins sometimes recover and go on to spectacular new heights. Most of the time they don't. In this case, there were multiple waves. This was a graphics company that went into crypto mining, so a huge benefit of that boom, and then obviously AI as well. So it's probably unfair to say that it was luck, but most companies won't have that such a strong recovery. What you can see is if you bought this when growth was peaking at 60 or 80% in 21, or when it first got above 100% in 22, you could make a small fortune. That's over $3 trillion of value. So even if you bought after the growth came through, you could still do spectacularly well. And you can also compare it to its peers here. So this is compared to AMD, which is its only real competitor in graphics, Nvidia, which manufactures Nvidia's chips, and ASML, which provides the lithography machines which Taiwan Semiconductor uses. Taiwan Semiconductor is in the blue, this 2330. So again, you see clear outperformance by Nvidia. You can do it in operating margins as well. Again, you can see this period of outperformance by Nvidia. It's just the operating margins are massively higher. Everybody in the industry acknowledges that it's by far the best solution, and that translates into higher operating margins and explosive growth. And you can see AMD just didn't have the same operating margin. Taiwan Semiconductor is surprisingly strong here, stronger than ASML. They're the only company with a scale to manufacture the most advanced chips at the moment. Their competitors, Samsung. Samsung is about a quarter, probably less now, of the size. Intel is far behind. And you can also see here, if we go back to like that AMD question, AMD throughout this AI boom never really saw that growth. It never really had the same explosive movements that Nvidia did. And basically the performance tracked that. So again, I talked about the old examples in the auto and smartphone industry. This is a very live example that's going on right now in semiconductors, where the companies with explosive growth and true customer love winning and creating trillions of dollars more value than their peers. Just a quick note. So last week, ASML reported. So I've always seen most of this industry is very consolidated now because it's so advanced that you really need global scale, as in global end demand, to justify making the investments in chips that are that advanced. That's really why it's consolidated. So Taiwan Semiconductor, the US government can't make the chips that Taiwan Semiconductor makes. China can't make the chips that Taiwan Semiconductor makes. The only way the Taiwan Semiconductor can make such advanced chips is because it's the only supplier, basically supplies the whole world. You need global demand to justify that kind of company. So it used to be Nvidia was a clear leader, Taiwan Semiconductor was the only manufacturer, and ASML was the only company that could make the lithography machines that Taiwan Semiconductor uses to print the chips. But that kind of like easy three winners is breaking down now. Taiwan Semiconductor is squeezing ASML. It looks like pricing is coming down. And a lot of ASML's equipment doesn't actually go to advanced AI. So you can see that memory was a huge portion of it, and memory has come down significantly. The other thing to note here is China is 49% of revenues, sales gone down to 47%. But the US is cracking down extremely hard on the sale of ASML's machines, and they're guiding now to about 20%. So it's going to be a huge bite taken out of their revenues. They also don't just sell to Taiwan Semiconductor. They also sell to Samsung and Intel, which are having huge problems. So there's three kind of issues: squeezed by Taiwan Semiconductor, which has vastly more power; regulatory crackdown on China, which will cut their revenues; and also this exposure to memory and weak foundries like Intel and Samsung. And then I took this chart from Fabricated Knowledge, and you can see that ASML has had this premium over these other suppliers. These are also extremely advanced, great companies in monopoly or duopoly positions, but ASML had that premium over it across the entire time. Now that premium has basically vanished, and it's probably fair. I wouldn't suggest it's coming back. This is probably the natural state of affairs now. So that was kind of behind the fall last week. Big drop in guidance and this contraction in multiple. But Taiwan Semiconductor, on the other hand, this was probably the sleeper hit. Nvidia obviously made more money, but this was trading at single-digit PEs not that long ago, or very low double-digit, 10 times. Now it's 18 times. You can still see that it's actually trading a touch cheaper than the rest of than these other semiconductor manufacturing companies. And it's a vastly more powerful position. So it's probably got a good chance to stick around. This shows Taiwan Semiconductor's capex forecast. Those in a couple of years, it's 40 billion plus. These are huge investment cycles, right? So a handful of companies in the US are going to be doing over 100 billion a year. It's interesting when you see people debate over auto semis, the path of future AI demand, and then you compare that when you speak to anybody in the industry or hear any of the leaders of the companies talk. In research, in Google, in Microsoft, they're all full speed ahead in investment. And in the investment world, everyone's trying to figure out which quarters that demand is gonna land in and who's going to capture the most value. It's pretty clear now that Nvidia is capturing the most value. Taiwan Semiconductor is also capturing a huge amount of value with those higher margins. Yeah, you can really see the industry strength here at the moment with Nvidia at the top, Taiwan there slowly capturing more margin. It's worth noting that the costs for Nvidia, this is operating margin, their gross margin is 75%. So that 25%, a lot of that will be going to Taiwan Semiconductor. And then you have ASML with less, and other companies like AMD really falling behind. But the big picture, if you zoom out from all those kind of questions, the demand is still there. Everybody's still investing. And the reason for that is quite fundamental. It's that increasing compute at the moment is still increasing the effectiveness of these models. So if that stops, that's when the $100 billion capex will be pulled right back from all the major tech companies, and there'll be a big sell-off. But at the moment, applying more power to compute to training, applying more compute is leading to much better outcomes, and that's what's driving the investment. And every time it seems like things are slowing down, there's another leg up. So in the latest OpenAI models, they're now spending a lot of time thinking, so a lot of time processing. So a lot more compute is being used. If a modern tech company is taking 75 seconds to think, to give you an answer, you can only imagine the amount of compute that's going on. It's literally whizzing up a supercomputer in the background and processing a lot of computations to get you that answer. And that's the current step change in demand for inference. The next step change will be when you have agents, when these companies aren't just restricted to chatbots, they're also going out, booking flights, speaking with each other, learning from each other, writing reports, getting back to you with their results. When those AI agents are free, that will also need a huge amount of compute. And they'll also be talking together, and they're not limited by the number of people in the world. They'll be limited by the number of things that people want to do, which is vastly higher. Which also brings an interesting question. I mean, I saw Elon Musk had a pretty big week last week. It's pretty inspiring, like catching a rocket, firstly flying a rocket up and then landing it in the same spot, challenging enough. But to bring it basically to a stop and then catch it was phenomenal. But that week he also presented these humanoid robots, which are controlled by people in other rooms, but still have the full functionality. So it's still very impressive. The question I have is, what does that mean for economics if you have these robots that are out there kind of effectively as economic agents, same as a person? You're buying, spending, potentially paying tax. Maybe each one is their own little corporation. Does that then uncouple GDP and economic growth from population? Because right now, GDP is very tightly linked to population. What happens when you have all these robots out there working, doing things, earning money, spending money? It's going to be, I'm not sure the answer to that. I actually just released a pod with Hashan De Silva. I work with Hashan De Silva on a number of the healthcare things we do. He's just launched his own fund, and we covered his history at Eli Lilly, the early development in GLP-1 drugs, Curvebeam AI, which we're in, Syntara, which has been a sleeper hit of ours this year. It's up quite a lot. They have a pivotal readout in a very rare blood cancer in myelofibrosis. I also quite like them because they're Australian, Sydney-based, and they're chemists. So they do all their drug chemistry. They developed it all themselves. Most of the ASX biotechs, they're like repurposing drugs or reformulating them, or they've taken IP that nobody else wanted. Most of them are kind of like that. This has 4 different modalities that it's going after, all developed in-house. So that's kind of exciting. And then Skin to Neuron is a private company. They basically seem to have cured Alzheimer's in a number of dogs. They're basically taking hair follicles, turning them back into stem cells, implanting them in the right part of the brain. And then unlike what usually happens, they're self-organizing and actually helping restoring memory function, which is more or less unheard of in an Alzheimer's trial. Usually you're just trying to slow it down as much as you can. These people seem to actually be curing dogs and restoring function with these new cells. Now, I've spoken to a few people about it. The verdict is kind of it's either going up 100x or it's too good to be true. So with that caveat, there's one, I'm not allowed to say who it is, but there's one major pharmaceutical company who's backing it, which is encouraging. And also you can actually go on YouTube, it's all public domain, and see people who own the dogs talking about them and see the dogs running around after they've seemed to have been cured or at least helped with their Alzheimer's. Also, dogs are kind of good models for Alzheimer's because they get the disease naturally. In most animal models, you kind of induce the disease somehow. And that's one of the reasons why animal models are so bad, because it's very different developing a disease naturally versus inducing it somehow. But in dogs actually get Alzheimer's and it kind of progresses the same way as in humans. So it's seen as the best animal model that we have at the moment. So just in this last section, I'll just talk about the risk management piece. So it used to be explosive growth, customer love, and now we're adding the third component, risk management. People ask, like, what do you learn over the last cycle? Obviously, you learn a lot, but it's not really about learning. It's about what have you been able to systematize and bring into the portfolio. And like we're up over 70% calendar year to date. It's almost entirely due to this risk management piece. In 2020 and 21, we did better, but that was kind of easier. That was like a really easy market. Kind of everything went up. There were many different ways to get outsized returns. This year, there were very few. It was, by some measures, the narrowest market in recent history. So you really had to be in a very small number of companies that perform. And basically, the risk model took us out of a number of things that subsequently blew up. It kept us out of software and fintech, which went nowhere. So it was really only this quantitative approach that got us the results so far that we did. It's very different to what we're doing only a few years ago. To the three parts to it. You kind of cut risk at clearly defined thresholds that are dynamic and move. Take profits around 2.5 to 4x. That's empirical. So I basically went through what would have happened if we just sold everything that went up 4x. The reality is we would have done outstandingly well because in 21 we would have basically sold everything, handed people back a 3x profit, and then gone again. I kind of knew a lot of this is showing stuff that I knew you kind of guess intrinsically but didn't know. Like I always kind of knew that if you sell things that go up 50%, it's not enough because you lose too much money on other things. 2.5 to 4x seems to be the right amount, and really it's optimal around 3 to 4x. 2.5 times is not quite enough, but it is good because if something does hit 2.5 times, then you really reduce your volatility. So that happened twice recently. So Drone Shield went from 80 cents, went up to $2, well over $2, and we started selling and we sold about 60%, and then it dropped down to $1 basically. Bit over $1. So we harvested a significant amount of profits just because we had that lower profit target. And Transmedics hit 2.3x, and we sold about half of it around there as well. And then that's come down about 20% in the last few weeks. So again, we've been able to reduce the volatility. So it's kind of a trade-off. If you want to maximize returns, you go for the 3 to 4x. But as you reduce that profit target, you reduce the volatility. And that's kind of what we're working on. And it's also worth noting the third component is this gives you clear levels at which to re-enter. So everybody has an experience or many experiences where you sell something and it goes up another 5x. This always gives you a point at which you should buy back in. So you can take a long-term view on something like Nvidia or semiconductors or it even works in like commodities or an exit on a risk model, knowing that you can get back in. You might underperform the stock or the underlying, but you will get back in and capture the majority of it. So I'll share this example of how the model can work. So Carvana, this is basically the story of our fund. We bought at $36, went up 10 times, just under 400, over $360. And then the wheels fell off almost entirely in the first half of 2022. It was almost it was a 99% drawdown. It was a total wipeout. I think we closed around 100, which if you go from 360 to 100, you're still taking a huge loss. The risk model approach would have actually told you to reduce risk around there, around $300, and buy back in at 15. And this purple line shows you what the performance of that would have been on a portfolio basis. And that's dipped to 43x. Now, I think this is kind of the future of asset management. You're going to have to use these kinds of decision-making tools. Now, anybody can use AI to code this stuff up. This is something I coded myself. We've hired a full-time developer to work on that as well with us. But really, if you think about it, active managers used to underperform. They basically are the market, and then they'd underperform by fees and costs, like 1 to 2%. Now you have these like quant funds that are stripping more and more money out. So it's like Jane Street, Citadel, Millennium. And I think even us, like even in the last few months, there's been millions of dollars of potential losses that we've now handed to somebody else purely on the back of these kinds of systems. This shows you Transmedics. So in Transmedics, could have got, with a risk model and a 2.5x take profit, you would have got roughly the same return, but your drawdown would have been cut in half. So the problem with us is we could always find these stocks that are going up this amount, but we always had these like nasty drawdowns. This model cuts that in half, and that's a new thing. This is a new component to the strategy that we've been operating for over a year now. And that's why I've got some of these examples. A recent example was Celsius. In June, it was still performing well fundamentally, and that bailed us out, dropped over 50% since, and actually turned into a bit of a wipeout. I think we might have got out of Celsius because there was a slowdown in growth that flagged it. But in ELF, there was no slowdown. In ELF, it was all steaming ahead with very high conviction. Still, risk model gave a sell. We got out. Somebody else took this 30% drawdown. It wasn't us. Whoever bought the stock that we sold. And that's why it's been really powerful. And you can also use it. This just shows you that it works on cyclicals like Qantas or Whitehaven Coal, but we don't own either of those stocks and don't really anticipate owning them. And also, if you do it over kind of 25 years, you can improve returns. This is Nvidia. You can see you've cut the drawdown from 90% to 53% and nearly tripled your return. Yeah, that's basically it. So that's a big change to what we're doing. That risk model piece was really a missing piece. Not only did we develop the system to systematize the learnings from the last few years, but the last year took us, I think in financial year 24, we're top performing Aussie fund in our category, and it did over 70% as well. So on an absolute basis. And a lot of that was due to these kinds of sells. There's actually 4 things that we sold like this. And if that was 25% of our portfolio that got cut in half, it would have been down 12%, 15% in the last 2 months, which we managed to avoid. So ask about changes to the team. So Joel's left to do his own startup. He's still staying on to advise our VC fund and help out. And I'm investing in his business as well. But he's gone down that route. If you want to know more about that, I can put you in touch. But it's pretty exciting for him. Obviously, he's now leaving the financial side and going into the operating side. We've also hired Saurabh Bhatia, who is our founding CTO of our venture studio, who's also helping with all of our internal tooling. We're basically building, the APIs are so cheap and tools are so bad and expensive. And my favorite kind of portfolio management tools have just been bought by private equity and basically have become horrible. So we're basically using the APIs to build out all our own tooling. And we're actually about to launch a retail fund, which will have new partners and 3 new people joining us. So the team's about to expand quite significantly. But there'll be more to that. I think I'll just wait until that's ready to launch, and then I'll share all the details around that. How will the US election affect markets and the fund? I think when Kamala was winning in the polls, that was definitely casting a chill over things. That was like the sell-off a couple of months ago. As Trump's pushed ahead, particularly in swing states, the markets relaxed. I think there's a lot of people waiting for this, though. There's been so many surprises in elections. I don't know how elections are always so surprising. They always seem to surprise. Like the moment it seems like Trump's going to win, but who knows? If Kamala wins, obviously you're going to have quite left-wing policies. It'll be worse for markets. Whether it's better or worse overall will be to determined. But there's no doubt for the stock market, I would say that Trump winning is better. And at the moment, that seems to be the case. So there probably will be some money unlocked, people waiting on the outcome of that. And that could, if Trump wins, that could lead to a Christmas rally, which you do often see. But if there's a surprise Kamala win, I don't think that would be great. That's my 2 cents. I mean, the way we're trading these things is with our risk model, which in a way will take all this stuff into account, but is independent of it as well. So if things start trending down, we'll be out, we'll minimize our losses, then I'll find a floor, and then we'll get back in at a different time. On that note then, thanks for listening. I'll wrap up. Try and do these more frequently. If you've got any questions, please get in touch. It's michael@fraziscapitalpartners.com. Thanks for listening in.